points one day, or repo rates might do something strange one day. Then it was quiet for a while. Unlike bigger crises, this one was only being looked at by people who were involved in the market or financial experts. People on the street thought, "What are you talking about? Repo, it's not like it matters." In other words, this was one of those mild disasters. I think that when the reverse repo ends, something similar will probably happen. One day, the Fed will have to say, okay, we're not going to reduce the balance sheet anymore. We will now go back to a time when managing the balance sheet was slow. Tuesday, meeting minutes from the October 31st to November 1st meeting of the U.S. Federal Reserve showed that members plan to keep interest rates high for a while. There is a better balance between aggregate demand and aggregate supply, according to the Federal Open Market Committee (FMC). This is because monetary policy is currently more tight and aggregate supply conditions are continuing to normalize. On November 1st, the bank didn't raise rates for the third time in a row. Instead, it kept the federal funds rate between 5.25% and 5% and 5.5%, which was the highest level it had been in 22 years. Lyn Alden does a great job talking about the future of money, especially the Federal Reserve and the rules it follows. Let's watch the video now. Please like, subscribe, and leave a review below while you're done. Generally, the Treasury tries to keep the ratio of T-bills issued to longer-term bonds issued pretty stable. And now the trouble is that they're putting out more than usual. It's not like there's been a recession or other problem in a while, but the deficits are very big. So there is this constant supply illusion that changes every quarter. Quantitative tightening is also something the Fed is doing. They are selling until maturity. They are letting bonds leave their balance sheet without reinvesting the money, so it's really a sale. Not many people from other countries want to buy right now because the dollar index is strong. People don't understand that. The foreign market doesn't usually buy a lot of treasuries when the dollar is strong, though. A lot of the time they're in cash defense mode. They're either selling backup assets or keeping things the same most of the time. On the other hand, they are more likely to be in reserve buildup mode when the dollar is weak. In other words, they're not really buying on average right now. Also, banks are being very careful with how long they lend money for. What's more, the number of treasuries they held dropped completely for the first time in a long time. Now that all of these buyers have pulled out, along with the huge amount of supply that is coming, the local non-bank sector has to take it all in. In other words, hedge funds, insurance companies, pension funds, asset managers, and individuals. And these are groups that don't usually have this much extra power. As an example, banks and the Federal Reserve both use levers. The balance sheets aren't as flexible to handle all of this. The reverse repo facility is one of the last pools of cash and liquidity that are still available. You can think of that as a spillover for the high demand for T-bills in particular, not for longer terms, just for that type of T-bill, which is like cash with no counterparty risk. I mean, the Fed is your partner, so it would be easy for money markets to swap some of their reverse repo risk for more T-bill exposure. There is at least $1 trillion worth of T-bill exposure right now that the market could quickly use up. This doesn't always happen, but it does right now. On the other hand, there is definitely less demand for longer-term securities like T-notes and T-bonds. On the T-bill side, the Treasury has been very active, which is interesting for a number of reasons. They haven't just stuck to their normal schedule and split of how they do things. For starters, it's the part of the curve that costs more. The Treasury needs to get the most out of a few things. One of them is trying to keep government costs as low as possible. Even though the yield curve is upside down, they are still releasing extra money on the short end. The second reason is that they don't want to hurt liquidity. They don't want to use bank savings to get money. They would rather pull from a reverse repository. That is, it was a bigger jump than usual for what the Treasury would do. It's just not something that most people do, I think. It's usually not very interesting when treasuries are refunded every 3 months. However, this was likely the first time that news about the Treasury refunding changed the markets more than news from the FOMC, because there was more interest in the FOMC. In some ways, the Treasury has been having as much or more of an effect on liquidity lately than the Fed. This means that these two forces have been at odds with each other. That's why it's interesting that there's another factor that can surprise us every 3 months. In October, prices for goods and services didn't move at all from one month to the next. There has been talk about how long the Fed should keep the policy rate in its current range of 5.25% to 5.5%, even though the Fed hasn't said it will fight against price rises that happen too quickly. The rate setter said that at the most recent policy meeting, everyone agreed that the current rate should stay in place. This will be made clear. In the modern era of balance sheet management, which started after the great financial crisis, it's become more of a problem. And for the time being, when there has been too much QA, it's like you've filled the bucket with as much water as it can hold. That money has to end up somewhere. So when they open the reverse fee service, it moves there. That money finally started to flow back into the market as a whole after they stopped doing QE for a while. So it was used a little in the first 3 rounds of QE. What will happen when it's gone? It's likely that the 2019 repo spike was the worst time for that. So that was the wrong problem. There is too much demand for T-bills right now. The reverse repo facility basically represents an extra $1 trillion worth of demand for T-bills that money markets would be happy to buy and take out of the reverse repo facility. In 2019, there were also big deficits that were a bit of a surprise since there wasn't a slump going on. At that time, debts were growing, but not as much as they are now. We weren't even in a recession yet. And the Fed was tightening money in the same way they are now. Repo rates just went through the roof out of the blue. So basically, the rates that banks deal with each other went up by about 7% overnight, out of the blue. So the Fed pretty much jumped in with repo action, not reverse repo, but repo, because the reverse repo was empty at that point, and there was still work to be done on the gaps. And the dollar was pretty strong at the time. That's why not many people from other countries bought wealth. It was kind of the same setup, and it showed up in the reverse repo market getting messy. The trouble is that if that had kept up, it would have spread to the treasury market, since hedge funds were the only buyers left at that point and were using repo to pay for their treasury purchases. Obviously, you can't borrow money at 7% and then buy T-bills that were paying very little at the time. This is why they came in and stopped doing reverse repo. Many people were trying to figure out what was going on at the time, including Luke Groman and me. At that time, there were a few experts. Our point was that this was mostly a problem of too many T-bills and that the Fed would, deal with it like a repo problem. The trouble is that there are too many T-bills compared to other types of cash. Due to this, the Fed will likely have to start QA all over again. In just a few weeks, they did that. In September, there was a repo spike. In October, they began QA, but they didn't want to call it that because all they did was buy T-bills. It wasn't for the goal of stimulating the economy, and they weren't buying longer-term bonds either. It was mostly just handling cash flow. They were just going back up to a balance sheet that was slowly growing again. So I think we might reach a point where the value of the dollar hits zero and stays there for a while as the Federal Reserve continues to withdraw money. Then, though, something strange moves. Bond prices might go up by 100 basis points one day, and repo rates might do something strange one day. Then it was quiet for a while. Unlike bigger crises, this one was only being looked at by people who were involved in the market or financial experts. People on the street thought, "What are you talking about, repo?" It's not like it matters, so this was one of those crises that wasn't really a crisis. In the same way, I think that when the reverse repo ends, something similar will happen, and the Fed will have to decide one day that they are not going to drop the sheet anymore. We will now go back to a time when managing the balance sheet was slow. In the third quarter, the US economy grew by 4.9% yearly, which made it look like prices were going up. Getting better.